Well, Pankaj Tibrewal is with us, founder and CIO at IKIGAI Asset Managers. Pankaj, good morning. Great to have you with us here. Thanks very much. It's a sort of incredible sort of market back at new highs. Lots to talk about. Pankaj, and you know that note that you sent out, right? I mean, learnings from 2 decades of investing. It's a fantastic write-up, and I think everybody should read it. You should make it sort of public on your website. Because it's quite rich in what new investors can take away from it. And one particular bit struck me, self-control in investing, the opposite of FOMO. Our market's a bit out of control right now. How would you read things, Pankaj? Especially in mid-caps, smaller caps, especially SMEs, etc. What's going on?
Good morning, Prashant, and thank you for the kind words. On the markets, I think it's an incredible last 3 weeks, from panic to euphoria. We saw Nikkei being sold off almost 20%, and now they are up 23% from their recent lows. S&P is almost 1% away from all-time high, and so are Indian markets now. So it's been complete panic to euphoria in last 3 weeks. But when I look at some of the data points, firstly on the earnings side, I think this quarter was not a great one as far as earnings are concerned. And I look at the data very closely. The NSE 500 companies reported 7% earnings growth on a headline basis. But when you bifurcate it into 2 parts, which is BFSI and the non-BFSI segment, there are about 89 companies on the BFSI segment which delivered 19% earnings growth. But the non-BFSI segment, which is the rest 411 companies, delivered just 1% earnings growth. So clearly there has been de-acceleration in terms of earnings growth. And our belief is that the first half would be weak as far corporate India is concerned on the earnings growth because margin base is quite high. The second important part to note is that most of the companies mentioned elections and heat wave as the constraint in the first quarter, to the extent that elections were mentioned 1,700 times in the NSE 500 con calls, and heat wave was mentioned as more than 100 times in the con call. So clearly we have to see that how the second and the third quarter spans out. Third important point to note is that the government capex is down by 35% in the first quarter. That means for the remainder of the 9 months, government needs to spend 1 lakh crores a month to cover their budgeted numbers, which looks to be a tall task, not an impossible task, but a tall task. And hence you have seen some sell-off in the exuberant names or pockets of excessive valuation, like defense, like railways, like infrastructure. Some of the capital goods have given away 20 to 25% returns. So my sense is that over a period of time, we need to avoid the pockets of exuberance. There are certain segments which probably are looking reasonably okay, but we need to navigate next 6 to 12 months carefully. I think this is a period where you should minimize risk rather than maximize return. I think that should be the trend. Also, one interesting point which we are noticing is that the breadth of the market has started to narrow down. Over the last 20 days, we have seen large caps doing slightly better than the mid and small caps, and sector rotation is happening at a faster pace. So I think a diversified portfolio will be the order of the day, and risk should be managed in a fairly decent manner. Second, on flows, I think some interesting data points there to notice out. Though domestic flows have been extremely strong over the last 4 years, we have seen about $100 billion of domestic flows. But something to note interesting out there, in the first 7-8 months in calendar year 24, 80,000 crores have come into sectoral and thematic funds out of the 2 lakh crores on mutual funds. This is a slightly worrisome sign because people are chasing returns. And don't forget, Prashant, that 50% of the mutual fund investor base now is 3 years old. That means they have seen one-way market. How they will behave when they see a 12 to 18 month sideways or a consolidating markets is yet to be tested. So don't take domestic flows for granted, on which the entire thesis and narrative is getting based on.
Pankaj, hi, good morning, and great to have you on the show. Good to be listening to your viewpoints. Just a word on thematics, right? Let me argue for the other side as well. Very true that people are chasing returns. but it's also the asset managers, right? Because that's where you can create new products. That's where you can bring new stuff to the market, add a little bit of marketing razzmatazz. So that's what's getting sold, and that's where the money flow is really coming in. But yeah, absolutely take your larger point. There is something to be a little concerned about, depending on how people are bifurcating their portfolios. But on to the point that you just made about this is the time to minimize risk and not chase returns. So let's talk about maybe profit taking. Nobody talks about profit taking. The time to sell, the time to lighten positions a bit. I know that across the mutual fund industry, I think cash levels have been rising 6, 7, 8%, some even higher. But at an individual level, where should one start trimming positions?
Surabhi, I think one regime change which we are seeing in the market over the last few months is that momentum and value, which was the classic trade for the last 2 years, 2.5 years, is slightly taking a back seat. And quality and some of the names on FMCG consumer are coming back. So that's a rotational trade or a regime change we are seeing in the marketplace right now. On the cash calls, I think from a risk minimization, I've always believed that cash is a double-edged sword. You can get one trade right one way, but to get both the trades right, it's a very, very difficult task. Maybe you may be very lucky. I don't possess that skill set at all, and I'm very realistic about my abilities in life. And I believe that portfolio construction is the key to survival in the markets. Over a period of time, nobody can predict future. I think Fed doesn't know what the interest rates will be or inflation. I think only thing which is in our control is our own temperament and emotion. And the second thing, how we construct a portfolio. At this stage, I believe that a concentrated portfolio could be at risk. I think a diversified portfolio across sectors and stocks and across good quality companies should be the order of the day. We should be taking out money from companies where there has been excessive valuation, where there is narrative at play. Many places we have seen that, markets are pricing in irrational exuberance out there in terms of expectation. And clearly, if you do a reverse DCF in many names, you will find that the valuations you can't justify. So I think rather than getting carried away by the momentum at the near place, we should take a fundamental call and trim positions where the valuations are in exuberance there.
But I know, Pankaj, I know you can't get into stocks, but at least name the pockets, for the benefit of viewers. When you say excessive valuations, pricing in the moon and back, what are you referring to? Is it capital goods? Is it defense? Is it PSUs? So some idea and some hints that, viewers can perhaps hold on to.
So Surabhi, look at this data point. This railways and defense combined market cap is 18 lakh crores today. 5 years back, this market cap was 1.2 lakh crores. So from 1.2 lakh crores, you have gone up to 18 lakh crores, which is 15x, which means 67% CAGR over the last 5 years. When you look at the profit growth, it's about 21% CAGR. So you have clearly seen expansion on multiples, led by various narratives and delivery by the companies. But is it very high? Because finally, most of these businesses depend on one customer, one policymaker. Should it demand such kind of valuation is the question we need to ask. So I believe that there are certain pockets like this. I'm giving you one example where from 1.2 lakh crores, the combined market cap has moved to 18 lakh crores. Profits have not kept pace. They are at 20% CAGR. Market cap CAGR is 67%. So similarly, in many other pockets, probably when fundamentals, stock prices are running ahead of fundamentals, we need to take a reflection and try and trim position and manage risk out there. These are the pockets where I mean by excessive valuation.
Okay, very, very helpful. Thank you so much for spelling that out, Pankaj. I think it's it's important to listen to prudent voices at this point in time and not get completely carried away. Great having you on the show. Thank you for making time for us this morning.